Hey everybody, welcome back to Investing with Wesley. You know, it's no surprise that to a lot of people, investing is a very confusing thing. There's a lot of acronyms, symbols, and figures out there that a lot of people don't understand. So in the next couple episodes, I'm going to help you guys better understand what all those terms mean and what they're about. In today's episode specifically, I'm going to get into ETFs. Specifically, what are they and whether or not you should or should not invest in them. Let's get into it. Well, for starters, ETF stands for Exchange Traded Fund. And really what an ETF is a fund that comprises of a collection of different kinds of securities. So you could have an ETF that is all about bonds, an ETF that's all about stocks, commodities, and even when it comes to stocks, bonds, and so on, it can get even deeper into each sector. So it can only invest in tech stocks or only invest in municipal bonds. An ETF is basically a collection of investments that you can invest in. So instead of spending money investing in each individual security, you could spend money investing in that one ETF and own a little piece of all those companies that ETF is investing in. Now, as mentioned earlier, ETFs can invest in a number of industries and sectors, but typically ETFs are set to track a particular index. A good example of this is the well-known ETF SPY. This ETF tracks the S&P 500 index. So this ETF invests in every company that's in the S&P 500. And not only do they invest in every company, but they invest the appropriate weight of each company. Meaning if Apple takes up 5% of the S&P 500, then they invest 5% of the ETF's funds in Apple to make sure everything is equal when tracking the S&P 500 index. As far as the tradability and functions of an ETF go, now just like stocks, ETFs are listed on exchanges like the New York Stock Exchange and the NASDAQ. And again, just like stocks, they can also be traded throughout the day. Now, when comparing ETFs to other kinds of collection-based investment models, ETFs are often more liquid, meaning it's easier to buy and sell when you want to, as well as they're cheaper when it comes to the fees. Now, the 5 most common ETFs out there are bond, industry, commodity, currency, and inverse ETFs. Bond ETFs might include government bonds, corporate bonds, state bonds, or municipal bonds, or even a mixture of all of them. Industry ETFs, however, aren't necessarily invested in bonds. They're more so invested in stocks and follow a particular industry like oil, gas, tech, energy, that kind of stuff. Commodity ETFs, just as you would assume from the name commodity, they track or invest in different kinds of commodities. So they would follow the real estate market, the gold market, silver market, crude oil market, and soon enough, there's even going to be a couple different cryptocurrency ETFs. And if you watched one of my previous videos, you'll know that I look at cryptocurrencies exactly like I would any other commodity. Currency ETFs will invest in other countries' currencies to take advantage of price fluctuations in the exchange rate between whatever currencies it's involved in. Now, really, the only 2 investors I know that would invest in currency ETFs are the Forex trader who is trying to make a profit based on the value fluctuations between their home currency and whatever currency they're investing in, or the more conservative investor that's protecting part of their portfolio and is trying to diversify. They would invest in currency ETFs if they feel like their own currency is going to dwindle in value due to astronomical inflation. Currency ETFs, just like you would assume, would invest in popular currencies. The US dollar, the Canadian dollar, the British pound, the euro, that sorts of stuff. Now, an inverse ETF is kind of special because an inverse ETF tries to make money while the market is going down or has a downward trend. This ETF attempts to make money during a downward market by shorting the market itself or particular sectors of the market. So if you were investing in an inverse tech ETF, then you would make money in this ETF when the tech industry has a downward trend or people are losing money. A good example is something that I did for myself as well as my clients when the market fell in 2020. I knew we were long overdue for the markets to go down. So when it was announced that the coronavirus had hit the United States and people were starting to shut down their shops and quarantine, I knew it was only a matter of time for the stock market to reflect the public's fear. So what I did for myself as well as recommend to some of my clients is that they sell some of their portfolios and invest in inverse ETFs. And while the market sank more and more, our inverse ETFs were going up more and more. And therefore we were able to either stop our losses or capture that much more profit. So when used properly, inverse ETFs can help you save your money and make even more money. and are crucial to everybody's portfolio with the right strategy. Now you might be thinking to yourself, well, how do you short a stock or how do you short a market like this inverse ETF does? Maybe I want to short a market myself and I don't necessarily want to invest in an inverse ETF that's overall. Maybe I just want to short one particular stock. How would I go about doing that? Well, in order to short a stock or a fund or anything else, in order to short something on the market, you have to borrow stock or shares in that particular company or fund and then sell those shares, hoping that the share price of the company or fund you're shorting goes down. Then you could rebuy those shares and give the shares that you borrowed back to whoever you borrowed them from. So if you do it properly, there's going to be a spread between the price that you sold your borrowed shares for and the price that you repurchased those shares for. That spread is your profit from shorting this particular company or fund. Now, for the everyday investors that want to short a particular stock or a particular company, it's a little hard to do so without being a big time investor. The best thing I could say, if you think the value of a stock is going to go down, then you could also simulate shorting by investing in puts. And these are option contracts that we haven't really talked about before, but I will get into investing in option contracts in the future. Buying a put option is you betting that the stock price of a particular company is going to go down by a certain amount in a certain amount of time. All option contracts have expiration dates. So if you do these put contracts on whatever company you want to short, you have to bet that by a certain amount of time in the future, this company's share price is going to go down by a certain amount in order to profit. But if you make that bet successfully, the profits can be astronomical, because whenever you do option contracts, whether you think the market's going to go up or down, one contract is equivalent to leveraging 100 shares of that company. So you can see that the profit and the losses can get out of control really quickly. Investing in options is not something I recommend to everybody, and you definitely need to know what you're doing before you get started. But in short, if you want to short, then a put option is probably your best bet if you're a DIY investor. As a whole, I think ETFs are really good investments, and not all ETFs are created equal, as I mentioned earlier in the video. So if you want to get into a particular sector or a particular market, or just want to mirror the overall market themselves, but don't have thousands and thousands and thousands of dollars to buy one share of each individual company in that market, ETFs are an extremely easy and cheap things to get into, and I highly recommend ETFs for anyone's portfolio. But again, not every ETF is made the same, so you still need to do your research on what kind of ETF you want to invest in. Me, myself, with my portfolio and my risk tolerance, I'm investing in the S&P 500 index, I'm investing in emerging markets in the United States, emerging markets in foreign countries, as well as a bunch of different commodity ETFs. So I'm very diversified everywhere, but only you know where you're at and only you know what you're comfortable with. So make sure whatever ETF you're getting into, you do your research just like you would any other stock. But until our next episode, I really hope you got value from this video, and I really helped give you some insight on exactly what an ETF is and whether or not you should invest in it. I'll see you next time.